record away. Okay. So today what we're going to do is we're going to run through the last bits of our planned classes, which is to go over advanced scenarios 7, 8, and 9. So our test booklet has those 9 scenarios in the advanced test. We've kind of looked over scenarios 1 through 6 to a degree. Those are the ones that just have the scenarios and then the questions about the scenarios, basically asking about the tax logic to them. But now 7, 8, and 9 require us to prepare sample returns in TaxSlayer and then answer questions based on the return that we prepare. So to that end, this should look fairly familiar to you because this is preparing you for this is part of what the home-built scenarios, what the homebrew scenarios are designed to do. You'll see some things that overlap between the homebrew scenarios and these test scenarios. You will see some things on the test scenario that I'm happy to say they've actually added some realistic features to the test scenario, some things that we do see on a frequent or sometimes infrequent basis. And I'm actually going to be doing these test scenarios alongside you because I haven't finished the advanced test myself yet. Okay. So advanced scenario 7, Vincent and Faith Hunter. Using the tax software, complete a tax return, including all appropriate form schedules or worksheets, and then answer the questions following the scenario. What we have here, oh, and special note, whenever entering social security numbers or employer identification numbers, replace the X's either as directed or with any 4 digits of your choice. So we actually have fake social security cards here. They have 4 X's on them. You can replace those with any 4 digits of your choice. Let me make sure that my screen share is actually sharing. It is. Good. So Vincent and Faith. Vincent is a 5th grade teacher at a public school. They are both married to one another and choose to file married filing jointly on their 24 tax return. Vincent worked a total of 1,800 hours in 2024. During the school year, he spent $844 on unreimbursed classroom expenses. Faith retired in 2021 and began receiving her pension on November 1st of that year. She knows, this is where some of the stuff gets a little unrealistic. She remembers that it is a joint and survivor annuity, and she remembers that she has already recovered $1,259 of the cost of the plan. Vincent settled with his credit card company on an outstanding bill. He did get a Form 1099-C for that purpose. But they do know that they were solvent as of the date of the canceled debt. They had not declared bankruptcy. Faith got $280 from jury duty, so she had to work for quite a while on some sort of jury box somewhere. Their daughter, Hope, is in her 2nd year of college pursuing a bachelor's degree in physics at a qualified educational institution. She has received a scholarship with terms requiring it that be used to pay tuition. They do have a 1098-T, and they do not have one from the prior year. They also paid for some extra dollars in addition to the tuition for her courses. They did claim American Opportunity Credit last year for the first time. Hope has not been convicted of a felony drug offense, and they are all US citizens. So we have these fake social security numbers. We have these, we have an intake, interview, and quality review sheet for this household. And now, based off this information, we can, and then we also have all the tax forms that they have. And based off this information, we can go ahead and begin working on this tax return. So we will start with adding in Vincent social. Oh, we will start with logging into the practice lab in the first place. So as always, when we only have the one password, it is train pro web, then log in with your own practice lab login. And then go to the practice area as you see fit. Excellent. Welcome, Mandy.
Hi.
We are just getting started, and we are going to begin. We're going to spend this session going over the advanced scenarios 7, 8, and 9 out of the test booklet. So if you want to pull up the 6744 or use the packet that you got, either way, we're going to start with advanced scenario 7. And I'm going to talk about stuff as I am entering the information myself. I may have started this one already. I did. Okay.
Is Firefox a personal preference or something suggested? I see Firefox.
It's my personal preference,
Okay.
but like Firefox or Chrome, either of them work really, really well with TaxSlayer.
Okay.
Microsoft Edge theoretically works with TaxSlayer, but it's kind of recommended pick either Firefox or Chrome.
Thank you. It was over a couple of years ago.
Yeah, we configure our laptops to use Chrome. All right, so where did I stop with the hunters? Looks like I finished up the personal information and then stopped. So I have here Vincent Hunter, his social security number, his date of birth, his occupation. He is an idealist, does wish to contribute $3. We have Faith Hunter. I will work off my own packet here. Oops, that's one scenario too far. Okay, I believe I am where I need to enter some dependent information. So based off of the intake sheet, we have Hope Hunter here. Well, let me just double check. Faith Hunter, social security number, date of birth, occupation. She did contribute $3. She does want to contribute $3. We have.
It's not on the sheet like it was years before where they had both husband and spouse here. Maybe I missed it. Maybe I'm used to it being bunched together. Does she want it? Does she want it?
Yeah, there are multiple versions of
Okay.
the intake form
Okay.
that are out there. For our homebrew scenarios, I picked the latest one, which was still not officially released, but it was last edited in November, whereas these were last edited in October.
Got it.
So I don't even think they've finalized the intake sheet yet.
And as a best practice, just to show best practice, sometimes there'll be a small first letter and all large. Look, I capitalize everything. I keep my capital locks on.
Yep.
Some people like it better than me.
You can use all caps lock, or you can use capitalization as normal. It doesn't actually matter to the system, because once it gets submitted to the IRS, it's all just data streams anyways.
Okay.
There's no case sensitivity to any of the tax stuff. So we have mailing address, your city, your state, your zip code, your phone number. You can put whatever things you want here. I would personally recommend use Texas just because we're in Texas, and so nothing weird happens if another state triggers other stuff. But you can pick whatever you would like. All right, I am at the point to add dependents and qualifying peoples, so I will go ahead and begin that. We have here Hope Hunter, and because this is a test scenario, I can rely on exactly what has been put on the intake interview quality review sheet, but ideally we should look on the social security card for her name and how to spell it. So her social security number.
60800.
Remember, do not read out their social security numbers out loud. I have to remind myself not to make that mistake. Her date of birth. This is a test scenario, so you can rely on dates of birth having been entered exactly correctly. She does have an SSN. She is a US citizen. She is her parents' daughter. Lived with them for all 12 months. And 2005 to 20. She is over age 18 and a full-time student. And they have already determined that she is a qualifying dependent, qualifying dependent who provides tax benefits. Yeah, she is different and older and doesn't have the same totality of information. So just in case, we'll take a look at the dependency charts. Once I finish scrolling through everything. Filing status is easy. They were married at the end of the year and want to pick married filing jointly, so we don't really have to worry about all that much. Hope is their daughter, is their child. Hope is under age 24 at the end of the year, a full-time student and younger than both Vincent and Faith. Hope lived with them for more than half the year, did not provide more than half of her own support. It doesn't say. It says in the interview. No, it doesn't say in the interview, but they've already determined that she is a qualifying child dependent, so we should expect that she passes that test. Not filing joint return cannot answer those questions for anyone except for the taxpayer and spouse. So yes, qualifying child for the purposes of dependency, and filing status, married filing jointly. All right, so we have that dependent established. We can continue past that. There's no identity protection PIN to worry about, and instead we hop into income, where we're going to start with W-2. This is for the taxpayer. It's for Vincent, who we marked as taxpayer. Employer identification number is 35700, and then enter 4 digits of your choice. I've entered 1, 2, 3, 4, and that causes employer's name and all that information to autofill. Although I disagree with them, with whoever entered this, abbreviating school district. We want to match the W-2 as accurately as we can. Address matches. The first person to enter this was obviously in Massachusetts. So we'll switch that around. Employee's name matches, employee's address matches, employee's zip code, city and state all match. Wages, tips, etc. Box 1 of 37353. Federal income tax withholding 3200. Social Security wages are higher by $1,000 exactly. 38353, which when we change that, the Social Security and Medicare withholdings now match. Then we have code Delta in box 12 alpha for 1,000 round, and retirement plan is checked in box 13. Then we have this silliness where somehow we are in the state of Texas and we have to record some state wages and income tax. But it will not affect anything on the return. So we can do that, then hit continue. except it wants a state ID. 57200, and then anything we want there. There. Simple enough to add a W-2. Any other W-2s for us to add here? I don't believe so. Nope. So now we can look at a fairly common form. There are multiple types of retirement income. The most common ones that we will see are Social Security income and the 1099-R, retirement fund distributions that will show up on a 1099-R. Whenever we get a 1099-R, we can always type in 1099-R in the form finder. We can always go to the income section, retirement income, and then add or edit a 1099-R. Note well that a 1099-R is not the same as an RRB 1099-R. The RRB 1099-R is railroad benefits, and those are very specific, and they are treated differently. They are an entire different form, for that matter. The RRB 1099-R is also not the same as the RRB 1099. Those are two different forms as well. The RRB 1099 is treated like Social Security benefits, entered in the same way. The RRB 1099-R is its own separate beast. We have a plain 1099-R here. Whenever we click begin, it'll prompt us to enter this form exactly. So we have a standard 1099-R. There's nothing weird about this one. This is for the spouse, Faith Hunter. Payer's ID is listed as the payer's TIN, taxpayer identification number, 41200, and then enter any 4 digits of your choice. The name has imported properly, the address as well. The zip code has not, because it was established in a different state. So we'll just swap that around as well. Recipient information is down below and has Faith's address and does not actually have her name listed there. All right, now we can come back to the top and look at the box information to enter. And this is where we're going to see one of the types of 1099-R, the more complicated type of 1099-R that we might find. There are a few things here that indicate a special thing must be done. Box 2A is empty. Taxable amount not determined has been checked. And there is an amount in either box 5 or box 9 Bravo. So again, let me just highlight on this form the things we need to watch out for. Because when these 3 things all coincide, that means that we have more work to do than just faithfully reproducing this form. When box 2A has nothing in it, when box 2B says taxable amount has not been determined, and when there is a number in box 5 or in box 9 Bravo. So what does this mean? Why am I highlighting these things in particular? What has happened here is that Faith, over the course of building up her retirement fund, I need to back up a little bit. Retirement funds are tax advantaged. There are tax benefits to taking money that you earn and just putting it into a retirement fund. The IRS, the federal government, the Congress wanted to encourage people to save for retirement. And Congress also wanted to prevent the IRS from taxing someone twice on the same dollar. Because you get income from your employer, you also get income when you pull it out of your retirement fund. Congress did not want the IRS to tax someone twice on the same dollar because I earned it and then I put it in the I earned it and it got taxed, and then I put it in the retirement fund and then I took it out of the retirement fund once I retired and it got taxed again. Congress did not want that to happen. So generally speaking, retirement funds are funded either pre-tax or post-tax. Congress only wants someone's dollar to be taxed once. So when someone earns a dollar, they can either, earns a dollar and wants to put it into retirement, they can either defer the tax and put it pre-tax into the retirement fund, or they can get it taxed right then when they earn it, and then put it post-tax into the retirement fund. What happens on the other end of that formula is when they pull it out, pre-tax dollars have not yet been taxed. So the IRS taxes that dollar when you pull it out of the retirement fund. Post-tax dollars have been taxed already, and so you get to pull that out of your retirement fund tax-free. The IRS ignores that income for the purposes of tax. What has happened here is that this retirement fund is not either or. Faith put in a portion of her retirement fund pre-tax and a portion of her retirement fund post-tax. So part of this part, but not all, of this retirement fund should be withdrawn tax-free. How do you determine how much you withdraw tax-free every year? There are a couple different ways to do that. We are only allowed to do two methodologies. One is when the retirement company has already figured out that number. If the retirement company puts an amount in box 2A and box 2B taxable amount has not been determined, is not checked, then your taxable amount has been given to you. The company already made the calculations. They're telling you that, we'll say $19,000 of this gross distribution is actually taxable. But what happens when you get a return, when you get a 1099-R that looks like this, where taxable amount has not been determined, that box is checked, taxable amount has not been determined, no amount has been put in taxable amount in box 2A, or sometimes they will put an amount in 2A and then check taxable amount not determined anyways. And then you have a number either in box 5 or box 9B. That number in box 5 or box 9B, that is how much money was put into this retirement fund post-tax. The trick here is that the IRS does not want your retirement distributions to start completely tax-free and then flip 100% tax-free to 100% taxed at a later date. What the IRS wants to do is spread out the tax benefit of your post-tax dollars over a certain period of time, over the expected amount of time that you will be pulling money out of this pension or out of this retirement fund. The IRS has authorized one way for us to figure out how much money should be tax-free, or really how much of that distribution should actually be taxed versus taxing all of it. Because taxing all of it would be the wrong answer. Making all of it tax-free would also be the wrong answer. But the IRS has what they call the simplified method through which we can determine how much of this distribution is actually supposed to be taxed. not ready to enter that just yet. So I need to enter gross distribution here of $20,000 and 100. It's going to automatically say a taxable amount. You need to zero that out. You need to check taxable amount not determined. You need to keep going through this. I know there's a key word there that you probably saw that we want to skip over for the time being because we need to keep finishing the rest of this 1099-R before we move on from it. So box 4, federal income tax withholdings. $2,010 of federal income tax withholdings. Box 7 is incredibly important. Box 7 is the code that tells the IRS what kind of distribution this was. There are several different types of codes that can be placed here. There are over a dozen, for that matter. The most common ones that you will see are 7, which is the friendly code. That means that this is a normal distribution and should be treated normally. The second most common distribution code you will see is 1, which is this is an early distribution. This taxpayer took their money out of their retirement fund before the IRS wanted them to, and therefore, unless we do something, they will be charged a 10% penalty for having pulled out their money early. There are other codes. There's code 3, distribution due to disability. There's code 4, distribution due to death. There's code G, golf, which means that it's a rollover. There's a couple other rollover codes. If you're ever interested, the 1099-R itself will typically have an instructions section on the back that says what a whole bunch of codes are. And as you probably expect, our short form Bible has an entire table of common 1099-R codes. So you can look up in the 4012 1099-Rs, and there will somewhere be an actual list of potential codes.
So it's on the back of the 1099. Yeah, the physical one.
Yep, typically right here. Box 7 distribution codes. Code 1, early distribution, no known exception. 2, early distribution, but the company has figured out an exception. I have never actually seen a 2. The companies are always lazy. 3, disability. 4, death. 6, section 1035 exchange. I've never seen that. 7 is the normal distribution. B as in Bravo is a designated Roth account distribution. That has some special codes here. Be careful of that one. Code Delta, code Foxtrot, code Golf. Code Golf is a pretty common, well, sometimes you'll see this one. This is for rolling over when someone takes money out of one 1099-R and just instantly puts it into another 1099, into a different retirement account. In which case the IRS says, well, you didn't actually take it out to use that money on anything, so we're going to treat that distribution like it doesn't exist. There's a whole bunch of other options, including a bunch of codes that they don't even tell us what they are. It's just they're out of scope. But in this case, we have code 7, the friendly code, and we have box 9, Bravo, total employee contributions of $15,000. There's additional stuff to check down here. For instance, this is where we can check if this was a rollover. And then we can also check here if we need to report this on form 1040 line 1H distribution code must be a 3. What does this mean? Like, this is code, right? This is code talking. You check this box if what they are receiving here is disability payments that should be treated like earned income. Line 1H is where the IRS summarizes earned income on the form 1040. So if they're receiving a disability and it should be counted as earned income, this is where you check that box. Thankfully, we don't have any state information on this one, but now that we've completed the 1099-R, we can come back up to just under the taxable amount section where it says, are you a public safety officer? No. Or do you need to use the simplified worksheet to calculate your taxable amount? We need to use the simplified worksheet to calculate our taxable amount because, again, we have taxable amount not determined is checked. Box 2A doesn't make any sense. And there is an amount in box 5 or box 9 Bravo. So click here for options, it says. And we want to use the simplified method worksheet. It'll give you some details about this. There is a note about when you cannot use the simplified method. If someone does not have the taxable amount on their 1099-R, and we can't either ignore it because it's all taxable anyways, or basically, if someone meets these criteria but cannot use the simplified method, then they are out of scope for us. In this case, it is absolutely within scope. Go ahead and click Use Simplified Method. Then we have more data to enter. Gross distribution amount is going to import from the 1099-R. Then it's going to ask, what was the planned cost at annuity start date? And this is quite simply how much post-tax, how many post-tax dollars did Faith put into this retirement fund? And you find that by looking in box 5 or box 9B. And that tells you exactly how many dollars you need to put here. So in this case, from 9 Bravo, we type in $15,000. Then,
Go ahead, I'm gonna grab a pen.
okay. Then, we need to put the date that this annuity started. Very, very few people remember exactly when their annuity started. Faith somehow remembers exactly when. If people don't remember, at least get down to the month. The month will tell you whether you need to delve a little bit deeper. If the month was not the month of their birthday, then the month is all you need. If the month that they started was the month of their birthday, then we actually need the exact date that they started. The reason will become clear in a few minutes here. But in this case, we have a test question, therefore they have exact answers. So they started on the 1st of November in 2021. There is no death benefit exclusion here. I'll be honest, I've never seen one of those happen. Oh, they have changed the way that they phrase this. Vincent and Faith remember that this is a quote-unquote joint and survivor annuity. Essentially, if the person whose name is on the annuity, if they die, their survivor will still pull this annuity. Will still pull these benefits, receive these benefits, I should say. So in this case, we do have to check the box. Hey, they added the automatic calculation. We no longer have to actually do this by hand. All right, so let me explain what's going on here. The IRS, like I said before, wants you to meter out the amount of tax benefit you get from your post-tax dollars. They want to meter out the amount of non-taxed income you get from your retirement fund. But they want to do that over a certain period of time, over a realistic horizon for you to be pulling money out of your retirement funds. In order to figure out what a realistic horizon is, they need to know how old you were when you started pulling out money. Because everyone has a certain life expectancy. And if you start pulling money very, very early, then they want to issue a very small benefit of tax-exempt retirement funds to you so that it can meter out over the entire period that you're pulling money. You're expected to be pulling retirement funds earlier, they'll reduce the benefit. If you pull out, if you retire very, very late, if you retire in your late 70s, early 80s, then the IRS is going to look at that and say, oh, you're getting pretty close to that calculated life expectancy. We should probably accelerate the rate at which you are getting the benefit from your non-taxable retirement funds. There's a lower limit and there's an upper limit, but the way we determine where someone falls on that scale for the simplified method is by calculating their age at the time that they started pulling the retirement funds. And this is why the birthday is, or this is why the starting date is so important, because it is the age that they were at the start date of the annuity, not on the 31st of that year. In this particular case, she started the annuity after her birthday. Therefore, the combined calculated ages are correct. We don't have to fix it. This box is incredibly important to check if this is a joint or survivor annuity. If someone doesn't know whether they have a joint or survivor annuity, they need to find out. Because if we don't check this box, or I should say, if we don't check this box, other way around. If I check this box and it's not a joint or survivor annuity, then what I've just told the IRS is that Faith retired when she was 123, which obviously is not correct. And it will throw off the formula. So we need to make sure that we check this box if it is a joint or survivor annuity, and we don't check this box if it's just for the recipient.
So Faith made 100% of the contributions to this, but designated as a joint benefit, therefore.
Yep. We don't need to adjust the age of the annuities. We do need to enter the number of months paid in 2024, which is really simple. It's all 12 months. Once someone starts pulling from their retirement fund, they will typically not renege on doing so. Then there's a public safety officer exclusion for health insurance premiums that's completely unrelated. I've never seen that come up. Then there's a box that says amounts previously recovered. This is a test scenario, therefore we have perfect information. Therefore, Faith remembers the exact dollar amount that she has previously recovered tax-free, $1,259. You will never run into a person in reality who remembers that number. So the question then becomes, how do we find that out when the taxpayer doesn't give that number to us? And the answer is you completely ignore that and you hit continue. That's the first step. You completely ignore the amounts previously recovered and you hit continue, and it pops you back to here, pops you back to the simplified method worksheet. Now it has told us in 2024, Faith received $20,100 from her retirement fund, and $19,519 of it was taxable. What we now do is we figure out, because the rate at which the IRS is issuing that tax benefit is the same every month from start to finish of this retirement fund. So now that we know what the taxable amount is within a year, now we can figure out the monthly amount of benefit. So I'm going to pull up a calculator and then pull it in from the other screen. We're going to take $20,100 and we're going to subtract 19,519 from it. And we find out that in 2024, over the course of a year, Faith received $581 of tax-free retirement funds. So divide that by 12 to figure out that Faith received $48.42 of tax-free retirement every month. How many months has she been pulling money out of her retirement fund?
It's 21.
Prior to 2024, I should say.
So she's taken it since November of 21, so
Yep.
that's 2 months.
Yep.
Plus 12, so 24, 26.
26 months. Take the 4842 or 4841, 6 repeating. Multiply that by 26, and you end up with a number that looks suspiciously like the answer. $1,259 after rounding. Or rather, it looks like the number that she has given us. She said she had already recovered $1,259 of the cost of the plan. That is how we can reach that calculation when people do not have this memorized.
So 2,100 minus 19519 equals, divide that by 12.
Nope, take 2,100, subtract 19519. That's the annual benefit.
Great.
So this is again how we can just find that, find the amounts previously recovered. Because now that we have this figure, we can go back into the simplified method worksheet, and now we can fill in this amounts previously recovered, 1259. And we hit continue. That number does not actually affect anything in the calculations. What it does do is it puts that number there so that the next year's person can summarize how much money they have previously recovered. Hit continue off of that simplified method worksheet, and it'll put you back into Form 1099-R, except now it has calculated the taxable amount. So that is the amount of her retirement distribution that is considered taxable. If you need to go in and change this, you can click here to make changes, and it'll take you back into that simplified method worksheet. Now that we've figured that out, now that we've got box 2A populated, we can scroll to the bottom or to the top and hit continue. Then it's going to ask, did you make an early withdrawal from any retirement accounts due to a disaster? In this case, they have not. So you can hit no. If someone has, then you mark yes there. It'll ask you some more questions. But that is how you complete a 1099-R that has a simplified method requirement. There are no additional 1099-Rs, so we can hit continue, and that'll dump us back into individual retirement account and pension distributions, wherein we have one more item to add into this particular menu. We have an SSA 1099. which is specifically a Social Security benefit statement. So we can put that into the Social Security benefits. And I noticed something weird on my printout. Is that the same on here? Yes, it is. They have, for some reason, fuzzed out box 5. That is
Refer to box 5.
rather important, yes. Let me double check one thing real fast, which is to see, site coordinator corner, there has been a volunteer tax alert to do with stuff in the test. Here we go. Advanced test, scenario 7, form 1099 SSA, which is not the correct name of the form, but I digress. On the form SSA 1099, in box 5, change the year, oh, they typoed the year as well. Change the year from to 2024 and put the amount to 23,899. Which in this case nicely kowtows with the rest of the form. So for instance, that figure shows up here in box 3 and in the description of amount in box 3 for the total benefits. Box 5 does not always line up with box 3 and the description of the amount in box 3. It oftentimes will, but it does not always line up. But in this case, we can jump into the Social Security SSA 1099 / RRB 1099 Tier 1. And because this is for faith, this is for the spouse, under spouse's Social Security benefit, we put 23,899. Under spouse's federal tax withheld, we put 2390. And under spouse's Medicare premiums, we have to look in the description of amount in box 3, where it says Medicare Part B premiums deducted from your benefits, 2096.4. For the most part, what you will see are SSA 1099s that look exactly like this. The box 5 amount will match up with box 3 and will match with the total benefits, and they will have Medicare Part B premiums and only those. You will every now and then see people with several parts of Medicare. If someone has Medicare Part B and Medicare Part D and Medicare Part etc., under Medicare premiums, you add together everything that is credited to Medicare. So if there's multiple parts, add together the total of those parts. And that'll get you the number that you need to enter here. There's a button down here that I want to highlight, which is lump sum payments. This is not something you will find very often, and it's not something that's occurring on this scenario. But what can sometimes happen is the Social Security Administration takes a while to make determinations when stuff happens. So what can occasionally happen is they will, after 3 years, they will message you and say, hey, we just figured out that we were calculating things wrong for you the past 3 years. So here's a bunch of money that you were supposed to get from us over the past 3 years. And they just dump the lump sum of back payments on you all at once. When that happens, it is not all taxable in the year that you receive it. It is taxable in the years it was supposed to have gotten to you. So what that would look like is, right now, this form says benefits for 2024. If someone has received a lump sum, it will say benefits for 2024, benefits for 2023, benefits for 2022, et cetera, et cetera. And that is when you would use this lump sum payments worksheet to enter the information. It's pretty rare to encounter that, but if you do, that's how you address that type of SSA 1099. And the 4012 will go into pretty exhausting detail in how to make that happen. But in most cases, this is all we have to do. Enter 3 numbers or 6 numbers if both people are in the household are getting Social Security, and then hit continue. Do we have any other 1099-Rs or SSA 1099s to add, or any other retirement funds? No, we do not. So we can hit continue off of this and return back to income in general. And the next form that we have is a 1099-C, Charlie, which is under other income. It is much, nope. It is not in this.
Okay, so Schedule C, sorry.
Yeah, Schedule C. It is pretty rare to encounter debt forgiveness, cancellation of debt. People holding debt are typically not in the habit of forgiving that debt and giving it up. But every now and then it could happen outside of a bankruptcy. In this particular case, New Bank has made a deal with Vincent to just, this $850, we're not going to try to collect it. You're good. Don't worry about it. What that looks like to the IRS is that looks like taxable income. Because what has happened in the eyes of the IRS is New Bank has just straight up given Vincent Hunter $850 that Vincent Hunter immediately turned around and used to pay off his remaining debt. So that $850 gets counted as taxable income to Vincent. And this is how we enter that. We can either go to the form finder and type in 1099 Charlie, or we can go to other income and then find a 1099-C, the form 982. And we can just click begin, form 1099-C. This is Vincent's, so we enter taxpayer. The creditor's name is New Bank. The creditor's federal identification number, 317001234. And the amount of debt canceled is $850. Hit continue, and that's all you gotta do. All right, tax forms continued. No, the last remaining tax form is a tuition statement, a 1098-T, and we are not yet done with the Hunter's return. Because remember, you have to save the 1098-T until the very end. We need to add in a couple more things. 2 more things, specifically. We need to add in the $280 that Faith received for jury duty. We actually should be in, I believe it's going to be under other income, but just because I'm not certain, I'm going to cheat and use.
I cheated and I didn't find it there, so I put it in other income.
It does not appear there. Let us check other compensation to see whether it has an item there. It does not. So we'll back out of there and hit other income. And we will select that this is Faith's jury duty or Faith's income. Type, there it is. Other income description has that drop-down menu. And so here we will say jury duty pay. And we will enter $280 of jury duty pay, which I don't believe is counted as earned income, but I don't remember either, so I will check the 4012 to see what it says about jury duty. Ah, perfect. Use other income not reported elsewhere. Jury duty pay not earned income for EIC. So I will leave the earned income box unchecked and I will hit continue. And that has added her jury duty income, and then we're gonna go and basically subtract all of her jury duty income from this household, because Vincent is a 5th grade teacher at a public school who has worked a total of 1,800 hours in 2024. Which means that he can claim up to $300 of educators expenses, which we find in the federal section top menu in the deductions menu under the adjustments sub menu. Educators expenses, we will list them under taxpayer, and he has way more than the allowable limit. Enter that 300, click continue, and now we have finished everything on the return except for Hope's college expenses. So we switch from educators expenses to education expenses, which we will find under credits, or we can just look up 1098T. 1098T tuition statement shows us this. First step, select who went to school. In this case, their dependent, Hope. Next question, do you have a 1098T form? Did the student receive form 1098T from the educational institution for 2024? Yes, she did. Did the student receive that same form in 2023 with box 7 checked? What are they talking about here? That's more gobbledygook. What they're talking about is box 7. Check if the amount in box 1 includes amounts for an academic period beginning January to March of the next year. If you pay your spring tuition in the fall if you pay your spring tuition on December 31st or before, then you should receive a Form 1098T that has this box 7 checked. Schools are notorious about filling out 1098Ts incorrectly. This practice return in general has a lot of stuff that, quite frankly, the providers of the tax forms usually fill them out wrong. The 1099R is often filled out in as lazy a manner as possible by the company, and the 1098T is often filled out either lazily or incorrectly by school accounting departments. But we have the form that we're given, and we have to work with the form that we're given. If someone's form does not agree with what they understand, they need to talk to their retirement company or their school to get a new form issued. There's not really a way for us to fix it on our end.
So here it's looking at the forward year, 2025 and 24, but the
Correct.
question is looking at the backward year. Was it checked in 2023?
Correct.
So we
And
know this.
in the interview, it says that they did not have their 1098T from 2024 did not have box 7 checked. Thank you. So what do we have here? We have the 1098T from Clark Community College. We have $5,722 in tuition paid. We have $3,202 in scholarships or grants. And then we have, by their interview sheet, another amount of money that they paid for books and equipment. What we have to do now is establish all of this in the system. So we mark no. And now we get to add the educational institution. So the institution name, Clark Community College, address 10 College Avenue at, let's say 76202 to match UNT's zip code. It'll automatically import as Denton, Texas. Employer identification number, we put as 388001234. EINs are not personally identifying information. It is a-okay for me to say the EIN out loud all I want. Now, the only people who will have EINs memorized are the people who have already sworn themselves to be a good person and not a bad person, ourselves. Eventually you learn to recognize what the Texas Workforce Commission EIN is, or Denton ISD's EIN. All right, this is now where we can enter tuition paid, grants and scholarships, and other qualified expenses. For the most part, we can just kind of enter this information as it's presented here straight. So in this particular case, we could do 5722, tuition paid, grants and scholarships of 3202, and then other qualified expenses gets into that question of what are qualified expenses, right? Which that caught us out on the Robert Bowles scenario. So let's double check in the 4012 for education benefits, just to make sure we fully understand whether the amounts spent on Hope's books and equipment are eligible. What expenses qualify? What are qualifying expenses? They have two sections that are titled the exact same thing. For the American Opportunity Credit, course-related materials are books, supplies, and equipment needed for a course of study, whether or not the materials are purchased from the educational institution as a condition of enrollment or attendance. The purchase of computer or peripheral equipment, computer software, or internet access and related services do qualify for the credit if the student needs the computer for attendance at the educational institution. There are very, very few colleges nowadays that do not require a computer as part of their coursework. So it is incredibly common to have a laptop, a new laptop, as a qualified expense for the American Opportunity Credit. For the Lifetime Learning Credit, qualified expenses are course-related books, materials, and supplies that are paid the cost of which is paid directly to the institution as a condition of enrollment. If part of the class includes paying an equipment fee to the school so that you will get access to school-supplied lab equipment, that is a qualifying expense for the Lifetime Learning Credit. If the school says you need to buy your own set of flasks and Bunsen burners and everything, and you buy it off of eBay, that is not qualified for the Lifetime Learning Credit, but it would be qualified for the American Opportunity Credit. And where it says stuff like needed for a course of study or course related, the criteria is really, does it appear on the syllabus as a required or recommended item for this class? If it appears on the syllabus as required or recommended, perfect, you are good to go from the documentation standpoint. So, looking at Hope's books and equipment. $1,500 for books and equipment that were required for Hope's courses. This information is also included on the college statement of account. So on the very, very last page of the scenario, it has listed a campus bookstore charge to student account for course-related books. And then using campus bookstore here is exactly why I include the Barnes & Noble complication on the Robert Bowles scenario. But in this particular case, at Clark Community College, their campus bookstore is very evidently part of the school itself. So we can indeed include the 1,500 here for both credits. And we hit continue. And then voila, we have established the educational institution and we have established the amount that was paid to it. I want to head back into this form just real quick.
I have a question.
Yes.
The other expenses for college, usually you have to like printing fees that you pay cash for at the time. There's a lot of cash thing that you might be also spending in home internets. You didn't include those in the other qualified expenses. Doesn't the person able to just say, hey, I have these expenses too?
We do not have any of that information in this scenario. Generally speaking, people do not add those small items. And also we have to be careful because again, it is still, for it to be a qualified expense, it still has to be course required.
Like internet at home where all the classes are online?
If it's an online course, then in theory that should indeed work. It's not going to be to anyone's benefit in this particular case because they're already exceeding, or no, they're already hitting the limit on, yes, they're already hitting the limit on American Opportunity Credit. You can take up to $4,000 of qualified expenses in American Opportunity Credit. And they have already breached $4,000 with this.
Okay.
Also, people will generally not have the records to back up that stuff.
I know that's complicated when you try to, for a Schedule C business, try to make it a home office, actually an office, what you use it for, so.
That gets real dangerous.
Yeah.
Yeah. We'll get to that in a later scenario. Okay, I wanted to come back to this page because I wanted to emphasize a specific thing. All education expenses, all qualified education expenses, regardless of who pays them, regardless of what they're for, expenses always go with the dependency. If a child can be claimed by their parents, their expenses for education go to the parents. If the child cannot be claimed, they are the only ones who can use the expenses. The parents cannot take the expenses of a child that is not their dependent. Expenses always go with dependency. Grants and scholarships, however, are income. Income always goes with the person whose name it is in. So income will always go to the student in this case. Grants and scholarships are always income for the student.
That had exceeded 4,700 or 50/50. That could have disqualified her as a dependent, right? If that's her income.
Yes. Now, the reason that it's laid out like this is because the system is automatically doing the simplest way for this to work.
Okay.
Which is there are multiple ways that you can benefit from an education dollar. Every dollar that you spend on education can be used either to trigger an education benefit credit or to cancel out a dollar of education-related income. of grants and scholarship income that, as long as those grants and scholarships could not be used for any purpose other than a qualified education expense. So you can't cancel out grants and scholarships that were used for room and board, because room and board is not a qualified education expense. You can't use grants and scholarships, or sorry, you can't use parking expenses. Every campus now charges an exorbitant amount of money for parking. And that is not a qualified education expense for education credit purposes. But every dollar spent can either go towards an education credit or cancel out education-related grants and scholarships. You get to decide, or the taxpayer gets to decide, how each educational dollar gets used in terms of what type of benefit they go towards. There are some cases where the parents are claiming a child in college where it is to the benefit of the family as a whole for you not to cancel out as much income as possible. It is sometimes to the parent's benefit, or it is sometimes to the household's benefit for the student to just take all that income as theirs, or take a portion of the income as theirs, because then that allows the parent to use that tuition or that qualified education expense to fund credit. The trick is really, does the student have more income? If the student doesn't have income beyond their grants and scholarships, then oftentimes, most of the time, their standard deduction will completely wipe out their grants and scholarships income. In which case, maximize the heck out of their parents' education credits. No reason not to. It is still perfectly fine. Trick here we have to be careful of is what you mentioned before. Make sure that the kid doesn't end up with so much income that they're no longer a dependent. So those are the things I wanted to note about that. Income always goes to the student receiving the grant. Expenses always go with the dependency.
So in a roundabout way, you're filing a joint tax return for the husband and wife, but you're also filing an income statement at least, maybe not a tax return for Hope, the daughter, all in the same form. If there was income, but there's not.
Yeah.
There's the standard deduction.
Yeah. One note about that, when there are more grants and scholarships than there are qualified education expenses, you do not enter anything in the 1098T section. You instead enter that as other compensation scholarship income. And you do that for the person whose name is on the scholarship. In this case though, they end up with $4,020 of qualified expenses. So we can hit continue, and then it's going to ask us some eligibility questions for the American Opportunity Credit. So basically, we have to answer these questions to make absolutely certain that she is in fact qualified for the American Opportunity Credit. First question, has the American Opportunity Credit or the former Hope Credit already been claimed on 4 prior tax returns?
No.
It is not. They've only claimed it once before. 4 is the limit. You can add the American Opportunity Credit to exactly 4 tax returns. Was the student enrolled at least half-time for at least 1 academic period beginning in 2024? And you're going to ask, where do you find that information? Well, it's straight up on the 1098T. If the school considers them to have been an at least half-time student, there will be a check mark on the 1098T. You can also ask them, were you a full-time student? Were you a half-time student? What sort of student status did you have? Did the student complete the first 4 years of higher education before 2024? In this case, the answer is really obvious, no. I am curious now whether they have clarified this, because in past years,
It's 23.
yeah, this is 23. It's been a while since I checked this as well, but. Nope, it is still just as unclear as it ever was. All right, so this is asking, did the student complete the first 4 years of higher education before 2024? Sometimes it's obvious. Like in this particular case, she's only been in school for 2 years, so obviously no. In my case, I've already been in school for an entire undergraduate degree and now I'm in a master's program. I have completed most definitely more than 4 years, no matter the definition that gets chosen. However, I have asked this of our IRS spec manager before. What does first 4 years refer to? Tax year, calendar year, academic year, student classification, or just undergraduate degree in general? And I've never gotten a straight answer. First 4 years could be taken to refer to freshman, sophomore, junior, senior year. In which case, what if someone came in with over a year's worth of AP credits and immediately started as a sophomore by credit hours? Am I then not qualified on the 4th year? What if someone's taking a super senior lap? If they take a 5th calendar year, but they're still technically in the undergrad program, does that count? What if they are taking part-time classes and they're just slowly accumulating credit hours over 6 calendar years, but they're still technically a junior? Does that still count? And I've never gotten a straight answer. So this is a really, really weird one. Reading this bullet point specifically hadn't completed the first 4 years of post-secondary education, generally the freshman through senior years. That suggests to me that it's classification. I'm going to ask again. I always ask every year. We'll see what they say this time. In this case, though, and in most cases that you run into, it'll be an obvious answer. Was she convicted? Was Hope convicted of a felony drug offense? No, at least not before the end of 2024. There's another section here which is, it's interesting, they forgot to actually ask about it.
Once you hit the continue button, you'll get it.
Oh, okay.
The lifelong learning credit.
No. There's one more question here that's important, which is to qualify for the American Opportunity Credit, you have to be degree seeking. You cannot just be taking classes for the heck of it or taking classes just to learn. You have to be on a degree plan. That is a requirement of the American Opportunity Credit. I'm surprised that they didn't include that question this year. But once you complete the American Opportunity Credit due diligence questions, now, if you answer them properly, Hope should be qualified for both the Lifetime Learning and the American Opportunity Credit. And this screen is much better than what we used to have to do. It used to be we had to calculate it as one and then go back and change it to the other and redo all the data entry and then see what that ended up being. But now they helpfully tell you, hey, pick the better one. So in this case, we'll select American Opportunity Credit and hit continue. We will still have to do that dual thing if they have expenses that qualify for Lifetime Learning Credit, but not, or if they have expenses that qualify for American Opportunity Credit, but not Lifetime Learning Credit. In general, though, American Opportunity Credit is the better credit. Number one, it will typically give you more money for the same amount of education expenses. It'll give you more credit for the same amount of education expenses. And number two, the American Opportunity Tax Credit is partially refundable, whereas the lifetime learning credit is not. Lifetime learning is entirely non-refundable.
Now we both have the same federal.
Now we both have the same number?
Yes, because
Perfect.
mine was different, I was concerned.
Never treat that number as final until it is final. All right. So, with the return complete, that's all we need to do. They do not have a 1095 to enter, and we don't need to finish all the e-filing stuff in order to answer the questions. What portion of Faith's pension from Liberty Enterprises is taxable? In order to answer these questions, I would highly recommend you go to the summary and print page and click on View Print Return. Then open up the printable return, the printable PDF that results. And here we can find, okay, here's the sample of the 1099-R that we created in the system. What is the taxable portion of Faith's pension from Liberty Enterprises using the simplified method? I'm going to pick an answer. I will neither confirm nor deny what answer you pick, whether it is correct, but it should be pretty obvious when you look at the form that you have created, as long as you have done it correctly, which I believe I have. Oh, you may need to enable the pop-up to some of that, because this does pop up in a new window. The next question they're asking is, are the hunters eligible to claim the credit for other dependents on their tax return? Well, the one thing you could do is you could go and look at the eligibility criteria for credit for other dependents, or you can just scroll to the appropriate place. So in this case, it'd be one of the schedules. So additional income, adjustments to income, no. It's going to be here, additional credits and payments. We have education credits, we have other stuff. Oh, here we have, keep going, here we go. Credit for qualifying children and other dependents. And just see which thing they fall under. So child tax credit and credit for other dependents. Number of qualifying children under age 17 with the required social security number, but line 4 is going to talk about child tax credit. And then line 6 is the number of other dependents, including any qualifying children who are not under the age of 17 or who do not have the required social security number. And so it sure looks to me like they have someone who is qualified for credit for other dependents. But you can decide whether that statement is true or not. Then there's a question that is just straight up, what is the total amount of other income reported on the Hunter's Form 1040 Schedule 1? In which case we just need to go to the 1040 Schedule 1, which is the additional income and adjustments to income page. And then we're looking at total other income. And then question 18 is talking about, hey, Vincent is eligible to deduct qualified educator expenses in the amount of, enter a number here. And it says, enter only the whole number, don't use special characters. And just in case they haven't updated tax layer properly, let's double check that. Educator expenses. Page E8, Echo 8. And what is the maximum benefit? Right there, $300. I mean, right there, a number. I cannot confirm nor deny whether any of these are the correct answer. technically I don't know myself. I haven't finished the test yet because they still don't actually have the testing software up and running. Did you know that they rescinded the opening of the testing software?
So we
cannot even go back in.
VSOC.
Nope,
Okay,
we can't do it right now. They are supposed to open it back up. Apparently they were not supposed to open it last week. They are supposed to open it back up at the end of the month. Which I'm looking at them and saying, hey, it's the end of the month. Nope, it's still,
okay. That's what I got it.
yep. Okay, so that's a minor bit of annoyance. But you see how the problem that we have, the sample scenario that we have prepared, they're asking questions that you answer by looking in the printout that you have created here. Any questions about that? I'm going to finish out my own copy of
The
the
question.
I'm going to finish out my own copy of the exam. In the meantime, if you want to get started on the next one, then you certainly can, scenario 8, or you can finish out these questions along with me. Standard deduction is going to be located here. Which of the following expenses qualify for the American Opportunity Credit? For that, you can actually just look at the 4012 and look at what are qualified education expenses. Taxable amount of Faith's Social Security income as reported on the Form 1040. So there is a section for Social Security benefits, and then there's a subsection of that that says the taxable amount. What is their total federal income tax withholding, which is literally just a test of did you actually enter the numbers properly? And now we have a return for Stephanie Winter.
So would that be because, would this number be high because they withheld state taxes for Texas on the W-2? So, because that's all coming back. If they withheld state taxes, you're getting that back, correct?
The state taxes do not appear
On the
on the 1040.
Okay.
This is entirely federal income tax withholding. So if you remember, where did they have federal income tax withheld? They had it withheld in a lot of different places. They had it withheld in the W-2, they had it withheld on the retirement income, and they had it withheld on their Social Security statement. So they had they had quite a lot withheld from a lot of different places.
Yes.
Which is why part of the reason that they're getting a lot back.
And it was a standard 10% they withheld, I noticed.
Yep, across the board. Generally speaking, we don't see all that much. We typically don't see that much withholding on the people that we're working with. One thing I'm going to show, just because this is a convenient place to show it, and I haven't shown you all yet. If you need to make notes about someone's return, if you want to add context for the next person looking at this return to understand, click on their name with the drop down in the upper right hand corner, and there will be a little thing saying notes. If you pull that up, it'll create a virtual sticky note that you can add to this return. Whenever you add in the note name and then some text, anytime you enter the return, anytime you try to e-file the return, it will bring up the note and it will say, hey, make sure you pay attention to this, just in case.
And you're gonna attach that sticky note to a specific page or line number?
No, it's only attached to the return as a whole.
Thank you.
But this is a place where there are several things that we will often put here, like, hey, their full name on the Social Security card is this. Sometimes there's some doubt as to which name the Social Security Administration considers to be the last name, especially with people of Hispanic origin who have multiple last names or who have compound last names. The Social Security Administration hasn't always gotten those right, and sometimes the names are so long when you put the full name on there that it will shove the middle name onto the second line. So this is a place where you can put, hey, something's funky with the Social Security card, this is what the full name says, just in case our site coordinators need to play with the name a little bit to figure out which one the Social Security agency recognizes, Social Security Administration. This is also a place where you can put like, hey, they're shopping around for a better refund, or we're partially done, but it's been quality reviewed except for the education credits. So all we gotta do is just add in the education expenses and then get that portion quality reviewed, and then we're good to go. But when you're in the note dialog, you can click anywhere other than the note dialog and it'll take you back to the return. I'm going to hit save and exit, and I'm going to have been timed out, and I'm going to be in live software. So I am not going to log in on the live software. Instead, going to head back to the practice lab. Train Pro Web. All right, we have a return here for Stephanie Winter. And we can start that return. All right. Stephanie is a paralegal, 26 and single. She has investment income and a consolidated brokerage statement. She is self-employed, delivering meals for Uber Eats, Fast Eats, on the weekends. She received a Form 1099 NEC and a Form 1099K. She received additional cash payments of $570, including tips, which she is being extremely dutiful and reporting them. That's pretty rare. Just gonna put that out there. Not many people report the cash payments they receive. We do have to ask, do you have any other income that we need to add to the Schedule C? If they say no, and you don't have any reason to doubt them, then you can just say, okay, cool, thank you. At the end of the return, they do sign that statement saying that when they told you, no, they don't have any other income, they were telling the truth. That's part of what they have to sign. So it is ultimately their responsibility as long as we ask the question. Stephanie uses the cash method of accounting. She uses business code 492000 and actually knows which business code she wants to use. No one will ever tell you what business code they want to use. No one knows what business code they actually are. Stephanie provided a statement from Fast Eats indicating the fees that she paid during the year. These fees are considered ordinary and necessary for the food delivery business. Stephanie also kept receipts for the following out-of-pocket expenses: $80 for tolls while making deliveries, a $300 speeding ticket, and $160 for Stephanie's lunch while she was working. Stephanie's record-keeping application shows that she has driven a total of 3,000 miles during and between deliveries. She placed her only vehicle and SUV in service on March 15th of on a very auspicious day. The total mileage on her SUV was 12,500 miles. No one ever comes in with the total mileage that they put on their vehicle that year. Of that, 9,500 miles were personal commuting miles. No one ever comes in with the amount of miles that they spent on personal mileage and commuting. And Stephanie will take the standard business mileage rate, which is good, because that's the only type of vehicle expense that we are allowed to touch. Stephanie is paying on her student loan from 2019. She's working towards her Juris Doctorate degree to start her new career as a lawyer. And she took a few courses this year at an accredited college. She did withdraw money from her IRA in April. She used about half of it to pay for her educational expenses for the current year. She has never made any non-deductible contributions to her IRA. All right, so filing status. Easy peasy. She's following the same exact tree that I do, so single filing status. Add in her information, so her name off her social security card. Her social's already in here. Her date of birth is accurately notated on the intake sheet. Her occupation. She has $3. Oh, they no longer ask full-time student there. Okay, not a full-time student. Does wish to contribute $3. All this is good. Address information 160. Put her in Louisville. I don't know. Spread out our samples around the community. But everyone that I'm entering has the exact same weirdo Hollywood phone number. All the fives. There are no dependents or qualifying peoples to claim, so we can continue straight on into W-2. This is also where I'd be asking a whole bunch of other due diligence questions, but for the purposes of the test, what we're given is what we have, and we can just continue straight through them. So, W-2s. Do we have a W-2? Yes, we do. Standard W-2, employer identification number 35800, and then 4 numbers of our choice. I'm going to put 1, 2, 3, 4, and that puts in, oh, she works at a casino. Okay. Address, employee name, address is all good. Wages, tips, etc.
You want to give to Kentucky?
Yeah. Okay. Might as well. It will not make a difference.
Right, because the state says not up to the practice.
Yep. 3,100 in withholdings. Boxes 3, 4, 5, and 6 are different by $1,000. But once we correct that, once we correct 3 and 5, then 4 and 6 should match and do match. Good. And we have code Delta box 12 alpha for $1,000 round. Retirement plans checked. And I'm going to break my own rule, and I'm just going to ignore the state stuff because this is Texas. We only have the one W-2 to add, so that is fine. Okay, let's see. Where do we want to go next? I think Let's enter the 1099-R real fast here, because this gets interesting. And we already touched the 1099-R beforehand, so we know exactly where to put this. Add a standard 1099-R. We have payer's ID of 48200, and then 4 digits of choice. I'm going to be lazy and leave that there, leave the state information as is. Recipient information, her address. All right, then we have box 1, 5,000. Box 2 has been labeled 5,000. Box 2 Bravo has taxable amount not determined checked, which is weird because they just gave us the taxable amount 5,000, right? This is actually pretty common. This is, the company is lazy and just said, you know what, we're not going to put our name behind this, you figure it out. This is incredibly common. Whenever you see this taxable amount not determined button checked, box checked, do not instantly start the simplified method. Immediately look at boxes 5 and 9B. And when we look at boxes 5 and 9B here, we see that there are 0 numbers in either box 5 or 9B, which means that all of it is taxable. We don't have to worry about the simplified method. There are no post-tax dollars included here. Instead, where we need to continue is, okay, she had $500 withheld for federal income taxes. It's pretty rare, but it could happen. And then in box 7, the distribution codes, we have to enter 1, the unfriendly code.
Early penalty.
Early distribution, a penalty probably applies. We do have that box checked for IRA SEP simple. If that box is checked, you need to check that box. Or rather, I should say, instead of a circular argument there, if that box is checked on the form that you receive, you need to check that box in tax letter. It's not a rollover, it's not a disability payment, so we can just hit continue. And it's going to toss a warning at us. Hey, you're saying this is an early distribution. Generally, if you do an early distribution, that early distribution gets taxed at an additional 10%. There's an early withdrawal penalty. TaxSlayer automatically tries to calculate that penalty for these distributions, but there is potentially a way for us to exclude part of this distribution from the penalty. Select the type of plan, in this case, a standard retirement plan, and then, since we're not sure, or really just always, check this box. If you have indicated that part of your distribution, basically, any time that you see a 1099-R with the code 1, I want you to immediately go to the 4012 and look for penalty on early distribution. Okay, let's just look for early distribution. And under other taxes in the 4012, there will be a section that talks about the Form 5329. The Form 5329 is the form that we can use to potentially exempt someone from the 10% penalty. That aspect of the Form 5329 is the only portion that is in scope for us. If anything else calls for a 5329 other than excluding someone from the early tax, from the early distribution tax, then that return is out of scope for us. But we are allowed to use this form for that purpose and that purpose only. But Teddy, you're asking, what situations qualify someone to be exempt from the early distribution? I'm glad you asked, because I'm glad I asked on your behalf, because there is an entire page that just lists these things are the reasons you can exempt someone from the early distribution. Anytime that I see anyone with a 1099-R, the moment that I see that and enter that, I will pull open this page and I will walk through all of these examples with the taxpayer. Generally speaking, none of the examples apply. Most taxpayers who received an early distribution received it because either they knew that they were going to have to pay the penalty, or they didn't even know that they were getting the early distribution. The most common reason that we see a 1099-R arrive at a VITA site with a code 1 is someone's work was just putting money away for them on their behalf, and they signed some random piece of paper in the whole employment onboarding document that established a retirement account for them. And it wasn't fully vested, but you know, the retirement account still existed. They didn't even remember that it existed. They left that job. They got a random piece of mail one day, several months after they left their job, that said, hey, you left the job that which this retirement fund was associated with. Tell us within 30 days what you want us to do with your retirement fund, or else we're going to cash it out and send the check to you. Usually that letter gets missed, or it gets misdelivered to an old address because they've already moved to their new job, or something else happens. That letter almost always gets ignored. And the default stance when that letter gets ignored is the bank will just cash out that retirement fund and send them the check. Don't care at all what happens to the person's taxes, they just send them the check. And they usually do not do any withholding on it. So what'll happen is that person, the taxpayer that we're working with, randomly one day gets a check. It's to them, it's from themselves basically. And they go, oh, free money. And then they deposit it or they cash it in. And at that point, they've just accepted income from their retirement fund by making an early distribution, and they will be taxed at the 10% plus the 10% penalty. And it's too late at that point. But usually in that case, none of these exceptions apply, but I will still run through every single one that could potentially apply to them just to see, because sometimes life circumstances happen. So, for example, and you'll notice a trend amongst these exception codes. Exception code 1. This actually was a qualified retirement plan distribution, and the retirement company just labeled it wrong. It wasn't supposed to be a penalty. It is actually supposed to be a qualified distribution. Number 2, same story. No, this actually was supposed to be a proper distribution to someone for retirement.
72T.
Number 3, no, this was not supposed to be an early penalty. This was supposed to be a disability distribution. Number 4, this was not supposed to be a penalty. The retirement company entered it wrong. This is supposed to be because someone died. Like, this is a standard death distribution. Code 5 is a little bit different. This is for retirement plan distributions up to the amount that someone paid throughout the year for unreimbursed medical expenses minus 7.5% of their AGI for the year. Okay, so what is this? This is a weird one. This is the exception where the IRS is okay with you having pulled out money because you had Mongo medical expenses. But only Mongo medical expenses. If they have what the IRS or what Congress considers to be a normal amount of medical expenses throughout the year, then you don't get that exception here. If you had a really bad medical year, then you can exceed that 7.5% of your adjusted gross income for the year. That is called, that 7.5%, that figure is called the medical deductions floor. Anything below 7.5% of your adjusted gross income does not count as excessive medical expenses. moment that your unreimbursed medical expenses goes above 7.5, then the IRS says, okay, that can start counting now. Where did 7.5 come from? Congress set it in order to make the numbers look nice. Literally no other reason. Congress just needed to make in various cases when Congress has passed tax legislation, what they have to do is they have to play with the numbers to make sure that the Congressional Budget Office is okay with it and the OMB is okay with it. And this is one of the levers that they will pull on a regular basis. They will just tweak that number randomly to make the numbers better. Anyways, all that to say, if someone's had a really bad medical year, maybe they can get exempted from some of the penalty. Number 6, no, this was not an early distribution that they voluntarily did. They were court ordered to cash out this retirement fund and send it to someone else. Distribution 7, no, this person lost their job, and because America ties our health insurance primarily to our work, they also lost their health insurance at the same time. So they cashed out their retirement in order to pay for their health insurance premiums. 8 is of particular interest to us. IRA distributions, very specifically IRA distributions, up to the amount you paid for qualified higher education expenses during the year, unless those education expenses were already paid for with a tax-free grant. That looks very interesting for Stephanie, doesn't it? So returning back to where we started, I got logged out. Okay. I've spent too long yapping. You've let me talk too much. All right, we'll see where it stopped us in the 1099-R.
So I did this wrong.
So back to the federal section, back to income, back to the 1099-R. I'm just going to hit continue to trigger this box again. Yeah, this is where we stopped. So this was a retirement plan, and we want to see for everyone, just always check this box. We want to see whether we can exempt Stephanie from this tax on early distribution. And anytime you see the screen, it will tell you what form you need to look at. You don't need to memorize form 5329. It'll say it right here in this last paragraph. So form 5329, we've checked, this is a retirement plan, we've checked, we want to try to exempt her from this penalty. Click continue, and it's gonna ask, hey, did you withdraw this money because of a disaster? Well, no in this case, but that is one of the reasons that you can withdraw money early without facing a penalty. Okay, now that we have completed the Form 1099-R, Stephanie is not happy because her summary is saying that she now owes $403. But let's go ahead and go to the form finder and type in 5329, the number that came up. And that'll take us to Form 5329, additional taxes on early distributions. And we can enter an amount that we want to say, hey, no, this is fine. This amount is not subject to the 10% tax. And then we select a reason for the exemption. And that reason, helpfully, lines up with that exact listing of codes on the 4012. So we're gonna say higher education purposes. And now we need to look at that 1098T that she's got.
That's where I added it.
Ah.
See, I added in the wrong, I added the right, I knew what to add, but I added in the wrong spot.
Yep, that happens, that's okay. That's why we're practicing. So her 1098T, I'll do it here as well so that we can follow along for those of us who are watching the recording. That 1098T for Stephanie says that she paid $2,400 for qualified education expenses and received 0 scholarships for that. And then in her interview, I don't believe it mentions any other qualified education expenses. I'm pretty sure 2,400 is all she had. Yep, 2,400 is all we can identify as qualified education expenses. So to that end, we will put 2400 here. And it has this little warning, hey, this exemption only applies to IRAs. Well, we verified it is actually an IRA. This is why that note is important. Boom, you entered 2,400 higher education purposes, and that's all we can do and all we need to do here. And suddenly her federal amount due will turn from 403 to a bit less than that once it loads. It should end up at 163. 163. I still haven't filled out everything. Okay, so no worries. So what that has done is that has removed the 10% penalty on $2,400 of that early distribution. It's still taxed at the normal rate, but it's just not additionally penalized. All right, so we entered the 1099-R. Next up, we've entered the W-2 already. Let's take a look at some self-employment. This is how we will address people who drive for Uber, for Lyft, for Uber Eats, for DoorDash, for Instacart, for whatever other rideshare or gig economy work that someone does. This also applies to small business related things. This is the Schedule C is how you enter small business related income. What is a small business or self-employment income of any kind? So where do you enter this stuff? Well, for most people who do gig economy stuff, they will have some kind of form or statement. At the I drive Uber every other weekend or so when I feel like doing it, they will just have a statement. They will just have a little printout from Uber that says, hey, this is how much you earned last year, and we don't give you a tax form because we're being lazy. Really, because you didn't earn enough to meet the reporting thresholds. That happens. When someone earns a lot of money, then they will receive a 1099 NEC for non-employee compensation, and they will receive a proper 1099K payment card and third-party network transaction. What you'll typically see is their kind of annual fee or their employee bonuses or whatnot will show up on a 1090, or their contractor bonuses will show up on a 1099 NEC. And usually most people's like per ride earnings will show up on a 1099K instead. So Lyft issues a 1099K for just about everyone. And then every now and then someone from them will have a 1099 NEC. 1099 NECs, however, are more common amongst, for instance, the janitor that we contract with to do cleaning in the United Way of Denton County office. We send her a 1099 NEC every year with her non-employee compensation. And she enters her 1099 NEC, or is supposed to, on her tax return under the Schedule C. Or specifically, let me go in the proper order here. We have a 1099 NEC. Click Begin here. Payer's information comes straight off the form. In this case, we have a payer that's a company, so we can do Fast Eats. This is their TIN, their taxpayer identification number, 634001234. See whether that imports anything. Oh, it imports something very different. Let's fix that. At the appropriate address and a random zip code. Recipient information is the taxpayer's name and matches. Then we have box 1, non-employee compensation of $1,000. So this is one of those situations where we have a tax form that we can reproduce exactly in TaxSlayer. So we do just that. When we hit continue, it's then going to say, okay, you've established that this income exists. What type of income is this non-employee compensation? What type, why did you earn this income? The 1099 NEC establishes that this taxpayer earned income. Now we need to establish what they did to earn that income. And Schedule F is out of scope for us. So it becomes really easy to know which one you select. Schedule C, business income. And now, what we are doing is we are establishing this taxpayer's small business. For the most part, the taxpayers that we are dealing with will not have a separate business name, so you can leave this box blank. They will not have an employer identification number, so we can leave this box blank because it's just going to default to using their social. They will generally not have a separate business address for that. They don't have an office for the most part. For the most part, what we're dealing with is just people driving on their own time on their own dime. So basically, you can leave this blank unless it's an actual small business. If it's an actual small business, they are probably out of scope for us. The only reason we are allowed to touch the Schedule C is because so many people at the income level we're working with do contract work. They'll do gig economy stuff, or they'll be working for a lawn and tree company that pays them cash in hand or pays them as a contractor.
It's not a formalized C corp.
Not generally, no. Generally, no. So for the most part, you can leave this blank until you come down to, oh, what business code do you want to use? Most people will not have a business, or most people will not know what business code they need to use. In this case, for some reason, Stephanie actually knows exactly what business code she wants to use, so we can humor her and we can put the code that she wants. 492000, and then it'll automatically pull up, oh, you're a courier or a messenger. Well, sure, close enough. The secret is, at our income level, this code does not matter. There is an income level at which point this code does start to matter. It starts affecting how the business income gets treated, but it is way above the soft income cap that we have. It is way above the hard income cap that we have. It's like $160,000 of business income or something like that. So enter the code, enter whatever description they want, then hit continue, and now we are in the Schedule C submenu. This is all the information about their business. What we were just doing was the basic information tab. And what we have done now is we have associated that 1099 NEC that we entered with this Schedule C. But we're not done entering income. Now we need to enter income. It is more income. It has already imported the $1,000 from the 1099 NEC. If we need to add more NECs, if someone drove for both Uber and Lyft and got two separate NECs from them, you can add a second 1099 NEC, and when you enter the second one, it's going to say, hey, do you want to add this to your existing Schedule C, or do you want to create a new Schedule C for this, a second Schedule C? If it is the same business, like that example, one person drives for both Uber and Lyft, you can just stack all those similar business NECs on top of one another. If, however, it is two separate businesses, if they got one NEC because they were driving for Uber and Lyft, and they got one NEC because they're a contract paralegal with a law office, then you need to establish two separate Schedule Cs. This person is doing two separate small businesses. But in this case, we only have the one 1099 NEC, so that's easy enough. We have two more types of income to record here. We have the 1099K that Stephanie received, and we have the cash income that she got cash in hand and that she has, out of some sense of civic obligation, mentioned to us. So since she mentioned it, we do have to report it, even though the IRS would not have known that she got 500 some odd dollars cash in hand. We enter income reported on 1099 NEC and quote unquote gross receipts or sales, cash that you got, cash or check or whatnot, but money that you got for work or sales, we enter that in this box. But we also have this little bulleted thing to the side. It looks like establishing bullet points, right? What this is, and there are multiple menus in TaxSlayer that have this option, what this does is it allows you to enter separate line items for each thing that you want to sum up into that one box. So for this case, I'm going to say 1099K. Okay, and it's not happy with me using a dash in this field. 1099K gross amount 8255. Sorry, no, 8225. Quality review would have caught me in that error. And then continue. And now we're in a multi-entry screen. So I can add in another item. And based off of our interview, I can say, well, she also got $570 cash payments, $570, or cash payments and tips. And what that has now done is now this has made it exceptionally easy for the quality reviewer to come back and verify that I have put the proper amounts for each specific line item. And then the system will automatically sum all of that up into this field. You don't have to use the bulleted list. You can just use a 10 key and you can add together the numbers and then just put the total number there. That's a-okay. I personally prefer the extra work to make the bulleted list because it makes it plain and simple as to whether I got it right.
So it would be redundant to add a 1099K too?
Yes.
Also, so I gotta take mine out.
Correct.
Okay.
A 1099K that is received for a Schedule C for a small business purpose should be added in this methodology. The 1099K that exists in the income section is for a complete other purpose. So we've completed the income of this business. We've completed one half of this business. The other thing we have to do for this business is figure out which of these expenses are qualified business expenses. And this is where things can get a little squirrely, because some things that Stephanie has presented, some of them are qualified business expenses and some of them are not. How do we tell the difference? In the 4012, there will be an entire subsection on small business expenses. in general, okay, I forget exactly where this is here, but in general, here we go. Here's the paragraph. To be deductible, a business expense must be both ordinary and necessary. An ordinary expense is one that is common and accepted in your industry. A necessary expense is one that is helpful and appropriate for your trade or business. An expense does not have to be indispensable to be considered necessary. The general rule of thumb is this. If Stephanie was not doing her small business activity, would she have paid that cost anyways? And if she would have paid that cost anyways, then it is not a qualified business expense. If it is a cost she paid just only because she was doing that business activity, then that is generally speaking a qualified business expense. So, the fees that she paid to Fast Eats, $150 for the insulated box rental. Would she have rented that box if she was not doing Uber Eats? No. And it's already mentioned, it's ordinary and necessary in the food delivery business. So, okay, that qualifies. $50 for a vehicle safety inspection that was required by Fast Eats. Yeah, the company required it for her to be able to work, so she had to do that because of that. $600 for fees that she had to pay to Fast Eats just for the privilege of working for them. Yeah, that's a business expense. And that is also, hint, hint, how all of these gig economy things make money. They charge their workers for the privilege of being able to turn physical capital into their car into liquid capital, money in their pockets. Stephanie also kept receipts for the following out-of-pocket expenses. $80 for tolls that she paid while she was making deliveries. Is that something that she would have paid if she wasn't doing the business activity? No. And it's also pretty normal, pretty expected. Like you're driving somewhere down a toll road, you're going to have to pay a toll. So that's probably qualified. $300 for a speeding ticket. Would she have gotten that? Is that business related? No, it's not. She sped. Oops, she broke the law. Breaking the law is not a qualified business expense. In fact, I think it explicitly says here, no, not specifically, but yeah, it's not. $160 for lunches that she ate while she was working. What do y'all think?
No, it's not accepted.
No, it is not exempt. No, it is not an allowable expense. The reason for that is, remember, it's got to be something that she would have been doing only because she was doing the business. Well, according to the IRS, you are expected to eat 3 meals a day, regardless of what business activity you are doing. And this does not qualify for business meal expenses.
Not a T&E expense.
Yep, this is not a travel expense. You will sometimes find people talking about travel expenses. And the key here is that she did not leave her tax home during the course of business. There's actually a whole helpful section in the 4012 that talks primarily about vehicle expenses, but there's stuff about tax homes in here. So meals, well, okay, let me keep going here. We've talked about general expenses. We're going to leave vehicle expenses aside, but the way we can enter the things we've decided are legitimate business expenses is you can pick one of these menus that the 4012 says, you can pick one of these items. Doesn't really matter which one, as long as the 4012 doesn't say, hey, don't use this one, it's out of scope. You can pick whichever one seems to sound best. In this case, I'm just going to say that the $150 for insulated box rental, $50 for vehicle safety inspection, and $600 for fast eat fees, they're all fees. So I'm going to say $800 here. And just to show that the bullet points are not necessary, I'm just going to leave that open. And then $80 for tolls. Where would that end up? I'll go ahead and I will check in the 4012 whether I'm allowed to use the travel section. General expenses. What's the next page? There's a page somewhere. Nope, that goes in capital gain losses. Yeah, okay. They're using an old screenshot in the 4012. So I'm just gonna, yeah, I'll enter it in travel, because why not? 80 bucks. It doesn't really matter that terribly much. You will see some taxpayers look at this and say, oh, meals. Yeah, I bought meals for people during that. Okay, well, remember, the Schedule C is really designed for people who are doing business. This whole contractor thing that we are allowed to touch, it's really kind of a kludge. Schedule C is not really meant for people who are employees in all but name. So what is this meals 50% and meals 80% for? Well, meals 50%, that's really for people who are taking their potential clients out to a steak dinner to try and win business from them through discussion over dinner. That is a business expense. They're trying to land a multi-million-dollar contract, so they take someone to a fancy steakhouse. The meal that that person buys for themselves is not deductible. The meal that person buys for the other person is deductible. Therefore, that is a 50% meal. Because they would have bought themselves dinner, however, whether they were working or not, they bought the other person's dinner because they were trying to do business. So that's the 50% meal. What's the 80% meal? The 80% meal is when someone is out of their tax home, they're traveling for work. In order to land that multi-million-dollar contract, they have flown someone to Las Vegas, and they are wining and dining that person in Las Vegas because that's how much this Raytheon contract means to them. The meal that they buy for themselves in the airplane lounge in Las Vegas airport, that is a meal that they are buying way the heck outside of their home in DFW because they are there for business purposes. And they're not getting a per diem or reimbursement of any kind, so that's just a straight business expense. That is an 80% meal. The meal that they buy for themselves way the heck outside their tax home. What is a tax home? I've used that word a couple times now. The tax home is what the IRS considers to be your general geographic area that you are reasonably considered to just kind of do business in. Why am I being so vague in my wording there? It's because it is that vague in the IRS's wording. The long and short of it is, one of our star volunteers, he's a volunteer site coordinator, John Hoos, has looked this up in tax court, in actual court cases, in case law. In the DFW area, the entire DFW metroplex is considered your tax home. If I drive into downtown Fort Worth, I am still in my tax home for the purposes of business. So there is no one at our income level that's claiming the 80% meals. All clear on that? Just little funny things that you notice. I have had to explain in great detail this to someone who was trying to insist that their drive into Dallas in order to teach music lessons to people in Dallas was eligible business commute because it was outside his tax home. It was not. He knew how far that drive was going to be when he accepted the job, and it's still within his tax home. Therefore, the IRS considers that a commute, not business mileage. Speaking of which, we've entered all the miscellaneous fees, the general expenses. Let's talk about business mileage and car and truck expenses in particular. Car and truck expenses are very common for us to enter on Schedule Cs. We are only ever allowed to use the mileage method of determining car and truck expenses, which is to say, we describe the vehicle, we dictate how long it's been used for business, and we enter the number of miles that it put in for business. And then the IRS takes the standard business mileage rate for 2024 and calculates the amount of money that counts as. We are not allowed to use actual expenses. We are not allowed to enter people's gas receipts. We are not allowed to enter people's repair bills for their cars. We're not allowed to enter people's information for car maintenance or whatnot. We are only allowed to use the standard business mileage. The standard business mileage is 67 cents per mile. And if you're thinking about that and doing the math, you realize real fast, that is some really expensive gas. And that's because the standard business mileage accounts not just for gas, but also for the wear and tear on the vehicle that each mile puts on. So basically, the IRS has a formula that amortizes or spreads out the big ticket expenses. Someone's transmission fluid needs to be changed, costs $500. Okay, well, that's accruing very, very slowly with every mile that they drive. So a portion of that 67 cents that the IRS credits every mile goes towards that eventual transmission change. The engine rebuild, that costs $2,000 once the car is like 15 years old. Well, it's accumulated that $15,000 of cost over the course of however long that car has been driving before that engine rebuild. So that's why business mileage is charged 67 cents per mile in 2024. In description of the vehicle, you can put basically whatever you want, as this is just making sure that if someone has multiple vehicles, whoever's auditing this will know, oh, this is associated with the Toyota Corolla. In this case, she indicates that her make and model of car is the SUV line of the SUV brand of vehicles. So, SUV is the description of the vehicle that we can put here. She's given us nothing else to work with. She actually remembers the exact date that she put the vehicle into, so that she started using the vehicle for fast eats purposes. Which actually in her case is reasonably believable, because she's going to remember, oh yeah, the day before everyone started freaking out about the pandemic, I started using this vehicle. Okay. Most people will not remember the exact date that they started. To be perfectly honest, it does not matter. The date that the vehicle was in service matters for depreciation purposes. And the reason that we are not allowed to take actual expenses on the vehicle is because depreciation is an actual expense on the vehicle and really should be accounted for. And we are not allowed as a VITA site to touch depreciation, period. Anywhere that depreciation shows up, it is suspiciously out of scope for us. Depletion we are allowed to touch. if we get royalties for someone who owns a gas well or owns an interest in a gas well, we can do depletion, which is separate from depreciation. That's a whole other thing. There's a section in the 4012 about it. If the case comes up, just look up that section in the 4012. All right, business mileage. The total business mileage, where was that noted? 3,000 miles. When people say business mileage, they should have a number ready for you. If they have to rebuild it from scratch, they can do that in the waiting area. They should have a number for you. If you're working in the intake area, make sure that they have a number that they want to put for the business mileage. They can figure it out on their own. What we don't want to do is have someone waiting there, sitting there for 20 minutes, just piecing together what their business mileage really should be while you're sitting there twiddling your thumbs. You could be helping another person with those 20 minutes. What counts as business mileage? There is a very helpful chart in the 4012 in case you run into anyone that is in the situation of that one music teacher that was arguing with me for half an hour. If your home is involved at all, it is not business mileage. It is commuting, with very specific exceptions that almost no one ever meets. From home to your first place of work is a commute. From your last place of work to your home is a commute. Commuting miles are not eligible to take as business miles. From place of work to other place of work is business mileage. So if I am driving for Uber and I accept a fare 1 block away from my house, the 1 block from my house to that first fare is a commute. That first fare to their destination is business mileage. Driving from that first fare's destination to the second fare's pickup point, that is business mileage. The second fare's trip is business mileage. Driving home from the second fare's destination is a commute. The smart people will take the first job really close to where they live and their last job really close to where they live so that all that mileage is business. You will every now and then get someone who wants to say, but my first place of work is my home because I have a home office. They can try to claim that. They will not do so at our sites because the attempt to claim home office is fraught with tax peril. John Hoos has again looked up the case law on this. And there have been cases where someone's home office was disqualified because they had almost everything perfect. They had an entire wing of the house, an entire office that they literally did not step into except for work purposes. And then they admitted in court that there was one time that they were doing laundry. And with the fully loaded laundry hamper, they walked past their office, and as they were walking past their office, they got called away by a family member to do something. And they turned into their office, set down the laundry hamper, went to help their family member, came back in, picked up the laundry hamper, and left. And that disqualified them from claiming home office.
Poison the well.
Yep. If someone wants to claim home office, they really should not do that at our site. They can take it to a paid preparer. If you want to look into the tax law, I can ask John to identify that for me, but I trust his research, and that was pretty stark. Like, it's pretty hard to have home office. You really need to have like a whole separate building on your property in order for that to work. All right, so long and short of it, I enter $3,000 here for business mileage. Technically, they have the commuting mileage and the other mileage section here. You do not have to put any numbers in here. They don't make any difference whatsoever for our purposes. The reason they have this here is that it does matter if someone is doing actual expenses and depreciating their vehicle. Because then a portion of their annual depreciation was for commute, a portion of their annual depreciation was for other. We don't have to worry about that, so we can leave this blank. Then there's more boxes. These are, again, mostly to do with depreciation expenses, but go ahead and check these boxes whether or not, if they apply appropriately. So she does not have another car available for personal use. Her car was available for personal use during off-duty hours. She does have evidence to support her deduction, her app. This is an anachronistic question. If yes, check if the evidence is written. It is not actually asking whether you physically wrote with a pen or pencil on a notepad your mileage. What this is actually asking is, did you keep contemporaneous records? Did you track your mileage as you were driving it? Or are you rebuilding this evidence now that it's tax time by looking up your routes on Google? She had a record-keeping app, and most people have now a record-keeping app. A lot of the gig economy stuff just includes it in their application to begin with now, where you hit start when you start your business trip, and then you hit stop when you stop your business trip. That is a contemporaneous piece of evidence that is contemporaneously keeping track of your mileage as you are driving it. So she can check, yes, the evidence is quote unquote written. Click continue. Click continue again unless you need to add a second vehicle. If you need to add a second vehicle, you can do so. But that is the completed Schedule C. Any questions about the Schedule C before we move on from that?
No question.
Good. You will fill out probably.
You get this up here? Did you get that total up there? I didn't see it.
Probably. I just got to go into the Schedule C. Yes. So that's what this small business should have ended up being. She earned $7,000 from this small business. Frankly, she earned a lot of income for only driving 3,000 miles. Generally speaking, you will find that most of the time that someone drives for Uber or Lyft or any of these gig economy things where they're driving their car, they're breaking even in taxes. In actual income, what they're doing is what I mentioned before. They're turning the physical capital of their car into liquid capital, cash in their pocket. All right, let's see what else we need to account for here. You all are already familiar with how to address a student loan because that was in one of the homebrew scenarios, so I'm not going to go over that. You all are already familiar with lifetime learning credit and how to enter that, and you've entered 2 other 1098Ts, so I'm not going to worry about that. What you are not familiar with is capital gains, and especially a combined brokerage statement. So, what we have on this page 101 is a combined brokerage statement. This right here. In fact, we have 2 pages of this. This is getting more and more common in our income level because a lot of investment companies have been trying to entice lower and lower income people to invest. To give them like $200. Put $200 away, it'll make you money. So you see a lot of these show up. The primary one you see is Edward Jones. They have done very, very well breaking into the market of the income levels that we work with. But there's more. There are other companies that will do this sort of stuff. Chase Bank does combined brokerage statement for investments as well. This is legitimately people are investing and therefore have dividends and capital gains. So how do you enter a combined brokerage statement? They won't look exactly like this, but they will look very similar. There will be a page that has substitute 1099 DIVs, substitute 1099 INTs, et cetera, et cetera. They don't issue these tax forms as their own form on their own. It's just part of the combined brokerage statement. So on the first page, for instance, we start with, hey, this is a form 1099 DIV, or this is all the information that would appear on a form 1099 DIV. So we treat it like we have a dividend form in hand. 1099 DIV will show, well, it did not actually show up for me. I know where to go though. Income, Schedule B. Forms 1099 INT, DIV, OID, original issue dividend. We don't see many of those. Interest or dividend income. Well, we have a 1099 DIV. We'll select this, hit continue, and then enter all the appropriate information on this page. So payer's name. XYZ Investments, and you will have to look far and wide for where exactly their name and their address and their TIN is on the combined brokerage statements. These documents are really bad at giving you easy to read stuff. So federal ID number 40200, and then I'm going to put 1234. Didn't import anything, unfortunately, so their address 456 Plaza at, we'll give it an Arizona zip code just because they mentioned Pima. Ordinary dividends, box 1A, 300. Qualified dividends, box 1B, 225. Capital gain that goes to Schedule D, 2A, is $350. That'll be important. Notice it's talking about Schedule D. We're going to touch the Schedule D later on in this return. And you need to make sure that the DIV has this information properly, otherwise your Schedule D ends up wrong. Then we have a whole bunch of zeros. We can skip on down to line 5, section 199 alpha dividends. Right here, $32. And then the rest of the 1099 DIV is clear. So if you have another 1099 DIV, you can save and add another, or you can just hit continue. Next up, we have a 1099 miscellaneous that has nothing in it. They've just included it because that's their standard template. Okay, so we don't have to enter anything with that. Next, we have a 1099 INT, an interest form. So again, we can enter that here. Interest income, payer's name, we have to repeat ourselves here. XYZ Investments, if I spell correctly, it'd be helpful. 0200-234, and then address is 456. 5087, just cause. And we have a box one amount of $50 and nothing else. So can hit continue, and that is that for the first page, except it says, hey, you had some exchange transactions, some broker and barter exchange transactions. Stephanie trades in stocks, or at least her broker trades in stocks, and then gives the capital gains to her. And that is what the second page is detailing. And we need to look at the second page. In a real brokerage statement, there can sometimes be hundreds of broker and barter exchange transactions. Generally speaking, we are able to bundle them. Generally speaking. Every now and then one will show up that we are unable to bundle, and usually those are out of scope, but once in a blue moon, you'll end up with one where you have to enter 50 separate capital gains entries, and it is a chore. Most of the time we can just use the various cheat code to get around it. But we're not in the appropriate section here. We're in interest and dividends. We're in Schedule B right now. So hit continue until you get back up to the top level income section and scroll down, and there will be a Schedule D, Form 8949, capital gains and losses that are reported on Schedule D. And this is where we enter stocks. And primarily, we work off of this top section. Stocks, mutual funds, cryptocurrency, collectibles, etc. If they are selling cryptocurrency, they are out of scope for us. Just a reminder. So when you say, I want to add some capital gains, it'll instantly drop you into capital gains transaction. Okay, first thing, describe the property. It's very vague. In this particular case, we have Nebraska Co. common stock and Iowa Co. common stock. So just because it's first on the page, I'm going to say Nebraska Co. common stock. So you can put whatever you want to here, as long as whoever's coming by behind you can tell what exactly you meant when you put that there. So put Nebraska stock. We have then a date acquired, a date sold, a sales price, and a cost basis, and then any adjustments as necessary. So what are we doing here? What we're doing is the IRS or Congress does not want the IRS to tax you on the full value of whatever you sold. So whenever I buy a stock and then sell it later on, I'm getting income from the sale of the stock. But that's not accounting for, I need to account for how much I paid for the stock in the first place. So I bought the stock for 40 bucks on the share. Well, let's be a little more realistic. I bought $400 worth of stock 2 years ago, and now it's worth $600. So when I sell it, I shouldn't have to pay taxes on the $400 that I put into it, especially because I've already been taxed on that $400 because it was in my hands. So instead, what I should pay tax on is the $200 that I've gained in the interim. And that's what we're doing here. We're saying, hey, Nebraska stock cost, Stephanie acquired this stock. Stephanie bought this stock on the 1st of January this year. 01. What am I saying? On the 20th of January this year. See, I'm fallible. I need to be QR just the same as everyone else. All right, there is an alternate option, which you can actually do that, and then you can select various, and that's the cheat code. You see how they have the totals thing at the bottom of this page? So for those of you online, they have this totals thing at the bottom of the page. If there are like 20 different transactions in this section of the 1099B, and they're all helpfully totaled up at the bottom, and they were all sold on the same date, then you can just say various for the acquisition date. And as long as it doesn't have any tricksy things on the back end that have to be dealt with on a case-by-case basis. If they can all just be summarized in that one totals section, you can do various acquisition dates and then summarize everything with the totals. Same applies for long-term transactions as well. And that will typically be our saving grace. But I'm going to leave that there since we have a plain acquisition date and then we have a plain sell date. So she held on to it for a little over a month. And what that means is that this is a short-term capital loss or gain. Short-term is within a year. Long-term is outside of a year. Then we need to figure out what's the sales price. What are the proceeds that Stephanie got from the sale of this stock? So $2,000. Then we need to report. This is where we report to the IRS, hey, this is how much she paid for the stock originally. And there are two types of cost basis reporting. Sometimes the cost basis is reported to the IRS, generally on the short-term transactions. Sometimes the cost basis is not reported to the IRS, generally on the long-term transactions.
Pre-2011.
Ah, is that the trick?
Yes.
Learn something new every day. So then that'll be exceptionally rare for us to find.
Yes.
But cost basis is reported to the IRS in this particular case. How do we know that? Because it says so right there at the top. It says short-term transactions for which basis is reported to the IRS. If someone does not have their cost basis, it really behooves them to do the research and find out what the value of that thing actually was the day that they bought it. You can find historical stock prices. And so if someone does not have their cost basis, they should spend a few minutes on another computer in the library looking up how much they paid. Because otherwise, that is not to their benefit. They will get capital gains taxed on every single cent of proceeds they received. If they inherited their stock, check the 4012. It's got guidelines on how to handle that. I don't remember them off the top of my head.
Step of pieces.
I remember those words being involved somehow.
So if somebody dies, they get it, they get the price at the date of death. So in other words, if my mother bought stock in 1980 for $1 a share, she died last year, now it's $100 a share, my cost basis is $100 a share.
Your cost basis is at 100. Okay, good to know. Good to know. Thank you. But regardless of what type of cost basis it is, just select the appropriate drop-down menu item and then enter the cost. So in this case, $17.50. And then enter any adjustments as appropriate. Be very, very careful. Check the 4012 if there are any adjustments. If during your interview you look at a brokerage statement and you see adjustments, check the 4012 to make sure that is actually within scope. Very, very few adjustments are within scope. If someone had to have their capital gains adjusted, the IRS mostly says, no, kick them over to a paid preparer. They've got something too complicated for volunteers. In this case, thankfully, they don't have that. But I do have a second capital gains thing to enter. So I'm going to say save and enter another. This is now Iowa Co. stock. for Iowa stock. Date acquired for this one is 2008. Dang, she was holding on to this for a while. Date sold was last month. Sales price is listed there as $3,100. Cost basis type was not reported to the IRS. Somehow, this particular stock has bucked the market trend of generally being positive over a long enough period of time. So unfortunately, we do record a bit of a loss here, $4,000 in the cost basis, which will actually completely wipe out her short-term capital gains. But that's all we gotta put because there's no adjustment here. We hit continue, and now we have a summary of all the capital gains and losses that we have entered. And there is now a capital loss of $650 on this tax return. And that is how you enter stocks, and that is how you treat a brokerage statement in its entirety.
So I had added my 1099 instead of aggravating in the Schedule C, but I can't delete it.
Your 1099K?
Okay, yeah, 1099K.
Okay. I believe
Because now it's directing me to Schedule C, and I can't delete what I put in there. Anyway,
oh, no, that's good then. Like, mine still shows that the Form 1099K exists.
but I think I might have duped it. I might have, because I originally had entered it as a 1099K, and then we put it on the line in the.
Okay.
Okay. Either way.
Check the Schedule C.
Okay.
Go ahead, go into the Schedule C. And does your income match mine?
Is it 50, 20, 90, 60? Yes.
Okay.
We're good.
Then you are good. It did not take the additional 1099K that you entered. That is one trick of this. When you have a Schedule C on the return, it will automatically say, oh, a 1099K must exist. I don't honestly know why it does that, but that's just a foible of TaxSlayer. So that's capital gains. And you've done everything else that return asks you about. So it's going to ask questions. The questions that it asks are about itself, duh. Yeah, there's two more 1098s to enter, but you guys have done those before. But you can look at the questions here, like it's asking, hey, what about short-term capital gain? You can pull that from your printed return. It's going to ask which of the following can be claimed as a business expense on Stephanie's Schedule C, and we talked about that. It's going to talk about, hey, how much of a student loan interest deduction can Stephanie take? And for that, you may want to take a look at what limitations exist in the 4012. It's going to have what is the total standard mileage deduction for Stephanie's business on Schedule C. And for that, I would say look straight at the Schedule C on your printed version once you've finished entering the last two forms. There's asking about, hey, how much lifetime learning credit does she get? Once you enter the 1098T, you'll find out. What is her additional 10% tax on the early withdrawal from her IRA on Form 1040 Schedule 2? There is still a portion, well, there is most likely still, I'm not going to confirm or deny whether A is a correct or incorrect answer, but a portion of her early withdrawal is probably still being penalized. So what proportion of that is that? Well, you can find out by looking at the Form 1040 Schedule 2 Part 2. And then, spoiler alert, Stephanie owes money. Is there a way that she can, is this one of the viable ways that she can reduce her, to avoid having a balance due next year? there should be a section in 4012 that talks about that, but there's a lot of things you can do. Primarily, the big one is, hey, just adjust your withholding upwards. And in order to figure out how much withholding you may want to do, the IRS has a withholding calculator online, and generally speaking, it's pretty good. Where it gets tripped up is when you have multiple small part-time jobs, or when you worked like 5 or 6 jobs during the same year, they're all withholding like they are the only job you ever held throughout the year. And so they start out by withholding very little. And then the more you work for them, the more money you earn from them, the more they will withhold as you climb up the.
So my question is about a soft, not a rule, but a soft suggestion.
Mm-hmm.
If they had $1,000 they owed the previous year and $1,000 they owned this year, they're potentially in a penalty, and we should just drive them the quarterly.
Yes, for people who have a lot of income via Schedule C, quarterly payments to the IRS are a very, very good idea. And then in general, if someone doesn't make enough from any one income source to do withholding in a clean place, quarterly income tax payments are also a good idea. There is technically a you didn't pay enough throughout the year penalty. The taxpayers at our income level are exempted from that if they file the right information. Make sure that they know they should talk to the IRS, like they should call up the IRS, and it's going to be annoying sitting on the phone with them, but the IRS will make exceptions for lower income taxpayers to say, okay, this is outside of your control and you also don't make that much money, so we're not going to penalize you for not having paid enough throughout the year. All right, let's see. Advanced scenario 9, Joe. And I recognize we're at the end of our time here, but I'm just going to go through this real fast to make any notes. This has childcare expenses, which you have done before. And this has marketplace insurance, which you have done before. And if you take a look at the forms, his W-2 has nothing unusual, so you should have no trouble with that. His 1099 INT has nothing unusual, you should have no trouble with that. Well, there is an early withdrawal penalty, but that's easy. You just type that into the appropriate box on the 1099 INT. And the health insurance statement, you should have no trouble with that, especially because unlike the one that I put in front of you before, this one actually has identical numbers for January through December the entire year, which means you do not need to enter 36 separate numbers, you only need to enter 3. So you already have all the tools that you need to finish out the advanced scenarios and take a run at the test.
So how do we access a test?
We have to wait for the IRS to release the test software again. I regret not instantly dragging myself through the advanced exam and just taking it right there on the spot when it was open last week. Yeah, so that's all I had planned for tonight. And that
This
is
the final class?
This is the final class. You are welcome to come back to other classes if you want to go over the materials again. I will be running through kind of my same shtick, but you are absolutely, I will certainly not say no to saying your beautiful faces again.
So for a guy that's seen this for a couple of years, I have to say you were the best presenter. And you were, I mean,
Thank you.
Because I never understood what the simplified method was, and I think I can make it halfway to the door and still remember it. So, thank you.
Good. I'm glad that's helpful. I'm glad. Working at this a while, I hope that I am halfway competent. Sorry, go ahead.
I will probably join you again for another review of this on Saturday.
No, that is perfectly fine. I'm happy to go over the materials again with you.
Are you recording Saturday?
I'm probably not recording Saturday
Okay.
because I've at this point recorded one, I feel pretty good session of every
Okay.
class.
For Saturday, you're gonna be further along than Lopez one. No worries. Okay.
Probably won't. This is about the right pace for everything, based on prior year instruction. So yeah, that is it. Closer to the tax season, well, first off, I will have more classes in December and I will have more classes in January. And probably like once in December maybe, or definitely closer to tax season in January, I will arrange some study sessions where we can sit down and go through any questions that you have on the advanced exam.
Okay.
So if you're having trouble with it, if you give it a try and somehow you don't score the 80 plus, then wait for one of the study sessions or talk to me and I will arrange a study session so that we can go through the exam and make sure that you're fully understanding what each question is asking and that you've prepared the returns properly, that you're interpreting the tax law properly.
Okay.
Thank you so much.
But you have gone over everything that is necessary to go through the advanced course, and you have gone over everything that is necessary to succeed as a volunteer. You can now prepare 99% of the returns that walk through our door just by the stuff you know now and referring to the 4012. There will always be a few returns here and there that we have to engage the site coordinator brain trust, and we all start texting like mad on our phones back to one another, like, hey, what about this? Oh, I found this publication. No, this case law says that this is the way we have to apply it. So if such a case happens, don't worry. The site coordinator brain trust is always eager to learn more and consume more knowledge and add to our understanding of how taxes work.
I did want to ask you, you said that you record these videos. Is there a way to go back and rewatch the videos at our own time?
There will be soon. I probably next week when everyone's dead and already checked out for Thanksgiving, I'll arrange these videos to be some sort of unlisted resource specifically for our volunteers.
Okay.
Yeah. So I'll have that out. I'll have the schedule for December trainings out, and I'll have probably some more information next week. I'll send out emails to everyone. But thank you for spending yet another weekend, yet another evening with me.
Yeah, it's nice to virtually meet you.
It's nice to meet you too.
Okay. That's it. Thank you. And you can hang out all you want.
I restarted your computer.
Oh, perfect.
Okay. So this is not my business. I mean, I worked on Wall Street,
Hey,
so
okay.
I was a trader.
Yeah.
Then I had to reinvent myself. I became a school teacher starting in 2003, and then I jumped back and in a couple of times to do mortgages and boutique lending.
Okay, yeah.
So I mean, with the underwriting, I knew pretty funky stuff on tax returns, but not enough to do this. And I was just offered a chance, so I said, hey, United Way is doing this. Do you want to volunteer? And sure.
It's fun. It is so much fun.
But it's not. You speak like you do this. Like you do this for. I mean, I got a P-TIN from.
Hey, okay.
So I mean, it's expired, obviously, but it's 2021. But anyway. Thank you for your time here, gentlemen.
Of course.
I don't know if you'll be working out of the Louisville or maybe the Flomo library, but.
Louisville for sure.
Oh, you
I've
will.
still got to talk with them, but Louisville for sure.
Oh, yeah.
Flower Mound, I know the librarian there, Lynette Robeson. It's just a question of.
The demographic's not going to attract a lot of our people.
Well, so that's a funny thing. There are 3,000 Alice households in Flower Mound.
Are they? Okay. Okay.
But the real question is, this is a year of transition. I'm letting go of the reins. I'm letting a new person take over program. And the question is now the year to expand
Okay.
at a site, which I don't know, maybe. We have a good volunteer base down there.
Okay.
We have,
So where are the rest of the people that, so, because when I was in Arizona, I would say that 90% of these chairs were filled with people with computers.
Yep.
And they showed up every week. Yep. We had a total of 5 people. So you're gonna have people have to staff all these sites? Or are these people that are experienced and not taking the classes over again?
there are about 15 to 20 people who come back every year, tax preparers who come back every year, and they can pass the advanced test in their sleep.
So I could float this out to a couple of people who are tax preparers that.
Oh, absolutely.
All right.
Absolutely.
Want to make it as successful as possible? I'm going to print your pen also.
Appreciate
Front
that.
desk.
Oh, yeah.
Thank you. I like this pen, by the way. All right.
It is nice.